Hi everyone, and welcome back to the Independent Dollar as we continue in our January retirement and savings series. Today's video is all about locked-in retirement accounts. If you've recently left your employer where you had a pension and are wondering what to do next, then this video is for you. If this is your first time here, we make personal finance videos in a way that's easy to understand so you can be more confident and independent with your money. If that sounds like something that you might be interested in, feel free to join us by subscribing, and let's get started on today's topic. While you've enjoyed the benefit and peace of mind that a workplace pension offers, your employment has now ended, either because you're approaching retirement or maybe you decided to change careers. Either way, you're left with a decision. What are you going to do with your pension? Generally, there are a few options to consider based on who and how your pension plan is managed, but here are some of the most common options. The first option is to keep your pension as is, waiting until retirement to collect your monthly payment. The second option is to complete a locked-in lump sum transfer. This is usually into another pension, a locked-in RRSP, or an annuity. And finally, in some cases, you might be able to transfer your entire pension into an RRSP account. Now, for the purpose of today's video, we're going to take a look at what happens when you're not ready to retire, transferring your pension into an RRSP is not an option, and you've decided to transfer your pension into a locked-in RRSP, also referred to as a LIRA. So what is a LIRA and how is it different from an RRSP? What happens to your pension when it transfers into a LIRA? And how do you complete the transfer between your employer pension plan and your new retirement account? LIRA stands for Locked-in Retirement Account. To make things simple, think of it as being similar to an RRSP in that you can purchase the same type of investments within the account. And the intentions of the account are similar as well, to shelter your money from taxes until you retire and to provide you with income in retirement. They are also both taxable when you start making withdrawals. And finally, at 71, they both need to be transferred either into a RIF or a LIF. With the exception of the word locked in at the top of your monthly statement, until you actually retire, it would be hard to tell the difference between these two accounts. However, there are some main differences that you do need to be aware of. First of all, you can't make ongoing deposits into the account, nor do you receive a tax deduction when you transfer your pension into your new LIRA. Unlike an RRSP where you have the flexibility to withdraw money at any time, with a LIRA the account is locked until you turn 65, with the exception of a few scenarios. Unlike a RIF, which allows you to withdraw money anytime that you want as much as you want, a LIF has both annual minimums and maximums on the amounts you are permitted to withdraw each year. Now, if you're not familiar with what a RIF is, I would encourage you to check out our video that explains the basics of how the account works. So what actually happens to your pension when you transfer it into a LIRA? Well, once you leave your employer, you'll receive a package from them listing out which options are available to you. In that package, your company calculates what the lump sum value of your pension would be as of that day. And this is the estimate of the amount that will be transferred into your LIRA. Their calculations are based on a few factors, like your years of service, any additional optional contributions you've made, your average salary, current interest rates, and the day in which they calculated the lump sum value of your pension. In some cases, you may only be eligible to transfer a certain portion of your pension or retirement allowance if you have one. If you're in this situation, then your pension package will include a separate amount known as an ineligible amount, and we'll discuss this portion a little later in the video. Now that you're ready to transfer your pension, how do you actually do this? Transferring your pension to your LIRA is done in 3 easy steps. The first step is to start by opening your locked-in retirement account. And this step's important because you're going to need your account number for the next step. And here's a tip. If you're doing this process yourself through an online brokerage, do not forget to complete the appropriate federal or provincial locked-in addendum forms based on how your pension plan is managed. If you're married or common law as well, you're also going to require their consent on these forms in order to transfer your pension. Your next step is to complete the paperwork from the package your employer sent you, indicating your new locked-in retirement account number that you now have from completing step 1. Once you've done this, you're ready to submit your forms. Your third and final step is to closely monitor the transfer, and I cannot stress this enough. Typically, a pension transfer can take anywhere between 3 to 6 weeks, but if after 4 weeks you haven't seen the transfer into your account, follow up with your previous employer to receive a status update on a weekly basis at a minimum until the transfer is complete. This is very important for 2 reasons. Not only is it delaying your ability to invest the money, a change in the interest rate environment can impact the value of the pension that you receive. Think of a pension as working in the opposite way you would imagine growth with interest rates. When rates are low, your pension is worth more. When rates are high, it's worth less. So if interest rates were to rise between the time you received your pension statement and the day that your pension is transferred, it's possible that the total value will be less. What does it mean if you have a portion of your pension that is referred to as an ineligible amount? An ineligible amount is a portion of your pension that exceeds the amount eligible to be transferred into a lira or an RSP, for example, on a tax-free basis. So unlike the amount that's transferred into your lira, the full ineligible portion will be considered taxable income in that year. So what are your options? You can either choose to take the ineligible amount as cash and either spend or invest as you see fit, or another option to consider would be to transfer it into your RSP account, assuming you have sufficient RSP contribution room. In either case, whether you decide to take the amount as cash or deposit into your RSP account, both situations will result in the full amount being added to your taxable income in that year. However, depositing the amount into your RSP will provide you with an offsetting tax deduction. Hopefully this video has helped clear up some of the process surrounding a pension transfer. If you found the video helpful, feel free to let us know by clicking that like button and showing your support by subscribing to our channel. Thank you so much for watching, and we'll see you back here on Tuesday.